Thanks, Gordy, and good morning, everyone. So we thought we'd just cover off a few of the numbers now. So our underlying profit of 103 million is an increase of 6.2% on last year. Our reported IFRS profit, which includes the unrealised fair value gains on our investment property, was 188 million, so $19 million up on last year. The valuation gain of 93 million is due to the development of 234 new units in the half, and these have been included in the valuation for the first time, and there's also been an increase in the pricing of 1.5%, reflecting strong demand for our village offering. We achieved a record number of resales in the half, with 454 units sold, which is a 12% increase on last year. Our operating cash flows are a record 256 million, which are up 17.6% on last year. And so we've benefited from the collection at some of the high-value villages we've been building over the last few years. Our cash receipts from residents exceeded 580 million, which is a record for any 6-month period in the history of Ryman. And these strong cash flows have allowed us to invest a record 360 million in new villages and care over the last 6 months. So how have we spent this money? So we've spent 238 million building new villages. We've spent $78 million on land, which has included $6 million on bed licences in Victoria. And it's meant we've been able to maintain our land bank at over 7,000 units and beds. We invested $26 million in upgrading our existing villages to further enhance the resident experience and the care we provide, and also spent $18 million investing in a range of projects such as the development of the next stage of My Ryman, system integration, and the technology to enhance the work of our clinical team and the way we provide care. With such a major investment during the half, our working capital debt has increased to 1.5 billion. We regard it as productive debt. We invest the bulk of it in new villages where we recycle capital, and this establishes a growing tail of earnings. We have a very strong financial position with total assets of 7.26 billion, which is up 17% from September 2018. And shareholder equity has lifted by 12% to 2.3 billion from a year ago. Again, we continue to have very supportive banking partners, and we've recently had the Bank of China extend their facility, and the Industrial and Commercial Bank of China, or ICBC, has just joined our banking syndicate. This means we now have 7 banks as part of our syndicate, and they understand our growth plans and strongly support us. Our debt-to-debt plus equity ratio is 40%, which is up just 1.7% from March. We've increased our bank facility overall to $1.9 billion, and with 98% of that having a tenor of 3 or more years. We're continuing to see the benefit of the developments being in high-value centres. The development margin for the half, if you exclude Malvina Major, was 25%, which is the top end of our range of 20 to 25%, on the back of these high-value developments in both Auckland and Melbourne. We also did a rebuild at Malvina Major, which was at no margin, as it was an earthquake rebuild, and therefore the overall margin, when you include this, was only 20%. The resale bank of gains still to come currently stands at 867 million. So these pent-up gains, we can expect our resale earnings to keep on growing, even if the housing market was flat for some time, because volumes will increase at our mature villages. Our deferred management fees will also increase as they reset to new price levels with each resale, so this creates a compounding effect. Demand has also remained strong, with only 111 units, or 1.6% of our portfolio, available for resale at the end of September. The first half saw a record number of resales, and available stock represents just over 1 month's trading for us. As currently we expect about 85 units to come up each month. Demand for the care we provide remains very high, and we closed the half with occupancy at 97%. The aged care sector in general is averaging only 87%, so we continue to outperform the market in this area. We also had pre-sales of 143 million at the end of September, showing strong demand for our new villages, and this is at consistent levels as in prior periods, as you can see from this chart. Our residents in Auckland and Melbourne continue to free up significant amounts of capital when they move into a Ryman village. In fact, property prices in Auckland would have to drop a further 12% from current levels before residents stop freeing up capital, and over 20% in Melbourne. And for service departments, they free up even more significant amounts of capital as they move into a Ryman village, and this represents approximately 30% of our retirement village portfolio. So what triggers our ability to grow is simple. It's our model of continuing to recycle capital at each village. Since listing in 1999 and raising $25 million, we have now invested $4 billion in our portfolio and paid out a growing dividend stream to shareholders of more than $860 million, and we've never had to raise any new capital. As David mentioned earlier, the outlook for our full year is for an underlying profit in the range of $250 million to $265 million. And so this would represent growth of between 10% and 17% for the year. We're expecting our build rate to be around 900 beds and units for the full year, and our plan is to keep lifting this to meet future demand. So thank you very much, and I'll hand it back over to you, David.